Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. Happy Wednesday, the 23rd November, day before Turkey Day here in the United States. All right, somewhat, quiet out there, except for one big move we'll talk about. Yesterday was a good day, 1.3% on the broad indices, both the S&P and NASDAQ pretty much tied for that metric on the day. It still looks like we want to. Positioning, I think, is weak enough on the long side that there's still some more juice to run up to the levels people are talking about, whether it's 4,100, what have you, on the S&P before year end. I think that could easily happen. You get numbers like a John Deere this morning, putting up 744 in earnings versus 711 consensus, talking about supply chain log jams easing up, higher crop prices, putting more money in the hands of farmers, helping them out with their business, whether they're buying new equipment, improving. They also cited infrastructure as a big reason for increased demand that they're seeing on their end. Companies executing across the board. We own it. Infrastructure is one of the big things we're looking at going into 23 in the forms of whether it be like an equipment maker like a John Deere or engineering and construction companies, mining, what have you. All those are going to be part of that picture going into 23. The Inflation Protection Act is going to enable a lot of projects to happen in that sort of vein. So that's, I think, one of the themes that is going to be investable going into 23. Taking a look at economic orders this morning. Durable goods new orders coming in at 1% versus 60 bips expected. So that's a more warmish kind of number. Fed fund futures not really doing much on it. They are reflecting an over 5% Fed funds for the peak sometime in June. And luckily the dollar didn't really go up on that either. Dollar is still weaker on the day. We did go and buy ourselves some TLT yesterday, going in on the long end of the Treasury, thinking that that's going to make sense, thinking that as things do continue to slow down, that'll be more the classic flight to safety move, up bonds versus down stocks into 23 as we do potentially go closer towards recession. The one big move today I wanted to talk about, natural gas, just monstering up. I saw up 9%. Really separating itself from WTI, third strong day in a row. UNG is going to open above its 200-day moving average, attracting some more interest from folks who like the technicals. We did pick up more Antero Resources. AR is one we've owned for a while. We took it down. Have had it at a pretty small weighting for a while as the stock's really been consolidating, but we did add to it yesterday after adding to it 2 days ago. So just seeing like the strength in nat gas might have some more legs to it. Looking at the predictions for a really cold winter in the U.S., that giant frigid air mass over the North Pole. There's a Bloomberg article on Sunday talking about LNG being sold out for years globally, which is pretty, I guess, problematic for some. And you look at exploration and production companies pricing at their 3 times EV to EBITDA. That's crazy cheap. If you get another big run in nat gas, those stocks should just do amazing. So we put a few more chips in there. We may continue to do so, looking at some other names. But for now, and I would definitely go with the valuation compelling arguments, because that seems to be winning the day here. You get some of the more expensive ones, even like I think Devon is north of 5 times EBITDA. Doesn't perform well. If you watch today, watch how AR does versus DVN, just as a comparison. Have an awesome Thanksgiving. We will come back to you Friday if there's something to talk about. If there's not, we'll come back to you Monday. But have a great time. Enjoy the football. Enjoy the turkey. Talk to you soon.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.